Good morning. Gee, I wonder what's going to happen today. Geopolitics just moved from the background to the trading screen. With the Iran conflict threatening energy supply routes and pushing oil markets into volatile backwardation, traders are suddenly being forced to price risk where that wasn't on the radar some weeks ago. Today on the show, Jason and I are going to break down some of these metrics with backwardation, with volatility, and some of the things to think about when you're trading these kind of markets. So let's get to that after the bell. First of all, I see double of us. I wonder if everyone sees double of us.
No, they don't. Remember, this was the
this is a new thing.
Yeah, remember that happened last week.
Yeah, that's annoying as can be. That is not fun. Anyhow, how are you, man? What's going on?
I'm doing all right, Lex. How are you? What's
I know you're gonna bring this lip thing up. So
yeah.
Before I had the lip thing, they were puffy. It was in Cabo, Mexico. I forgot to put sunscreen on the lips, whatever you call it, so the chapstick. And they just got puffy. And I don't need to be puffy because I already have big lips. So it just kind of scabbed over. It's not herpes simplex 12 or anything. It's just
okay. Well, that's good to know.
A little issue I'm having right now. It's not very screen worthy, but we're gonna have to deal with it.
Well, you taught me a lesson when you have the Tradier Hub Summit in May in Miami. I'm going to be putting on that SPF.
It's not Miami. It is Palm Beach, West Palm Beach. We'll talk about that later. But it is, folks, it's an official go. So make sure you look at things. It's a go. We just found out 2 days ago. All right, let's get to it. So we wake up on a Monday morning, I think a week or so ago, and bombs are blasting over in Iran, right? That all of a sudden causes the futures to be down, 100 handles overnight, right? Which is obviously going to bring volatility to newer levels, I should say. And that's another reason. If you guys are trading the zero DTE stuff, it's a tricky game over the weekends. I've kind of convinced myself and taught myself the Friday to Monday play isn't necessarily one I like to do because that's when all the news comes out over the weekends, typically, right?
Nowadays.
Yeah, nowadays.
Usually no, but nowadays with Trump.
Yeah, right. You just get some craziness. Now, if you're playing for craziness, great, good for you. If you're not, you're playing for sort of calmness, you might want to take a look at Fridays and call it a day, right? So, anywho. All right, so let's talk about what happens in these kind of markets. Obviously, we have implied volatility skyrocketing. Although, I will say this, it's risen, but it really hasn't, in my estimation, skyrocketed. It's not like it's in the 30s, right?
Yeah, I mean, we overfixed on Monday morning and then bounced and kind of normalized a little bit. And then we overfixed again on Tuesday. And Tuesday, we had backwardation, which, I figured you as a former market maker can tell us what's actually happening when there's backwardation going on.
Yeah, so do you follow that at all? I don't know if my little remarkable is going to work here.
Yes, all the time.
Okay, get into it a little bit with what it is. Just define it real quick. Let me see if I can get this started here.
Yeah, while you're doing that, typically when you look at the option chain over time, so implied volatility in March versus April versus May versus June, it normally is in a state, at least in equities, it's normally in the state of something called contango, which means that it is upward sloping, upward sloping until like a point, and then it kind of flattens out a little bit. This is because that there is more implied volatility because there's more things that can happen, quote unquote, over the next several months than over the next month. And so it kind of takes that all into account. That's normally what you see in like calmer markets, something where it's not moving, maybe like a little bit of a bullish market or something like that.
Right. Go ahead. Sorry.
In times of high volatility, there will be times where the near-term options will increase in implied volatility, so much so that it will be higher than the implied volatility like in the out months. And that's what happened on Tuesday. It didn't happen on Monday so much. I mean, it kind of did a little bit, but then it receded in the middle of the day. In Tuesday, we got into a state of backwardation. You can almost kind of think of it like if you're a fixed income trader, it's almost like the inverted yield curve, right? Like it's something like that. That's the equity version of it, I guess. The equity option version of it.
No, that's good. So let's go to my remarkable. It's actually working. I don't know how long it's going to stay alive here. Do you see that? Okay,
I see it.
My beautiful chicken scratch. So in number 1 up top here, I'll write number 1 and then number 2. Okay, I drew contango in number 1, and I drew backwardation number 2. So all the axes mean is the x-axis down here is time. Okay, so we're going out in time. The y-axis is implied volatility, IV. Okay, and typically this is how VIX would look is in the contangled state. Would you agree with that, Jason?
In equities, yes.
Yeah. So even the VIX itself is tends to be contangled most of the time.
Like in stuff like metals, sometimes I think it's
it might be different in some of those commodities.
Yeah.
Backwardation, however, the nearer term all of a sudden becomes very volatile, like we're seeing now.
Yes.
So you start to get very big swings in the SPOOs, and the SPOOs are my term for S&Ps. QQQs can move a lot. NASDAQ, all those things get kind of crazy, right? So then you get into a state of backwardation. Now, why is this more normal contango? And you just said it, right? You want to say it again? Most times, when we're in a kind of a normal market, when you add more time to the equation out in this area here, there's more chances for things to occur. So they price that in a little bit in farther dated things. And then when it's kind of stayed around, near-term expirations, they kind of pound the hell out of volatility. And rightly so. It makes sense, right? Now, all of a sudden, what happens when you get a Trump tweet or a bomb dropping or a mini war or an invasion, whatever you want to call it, all of a sudden, near-term things start going crazy. We get a 1 to 1.5% move overnight a lot. You start seeing that. All of a sudden, that's going to lift that front part of the curve. It doesn't mean, I want people to understand this, it doesn't mean that this back part doesn't go up a little bit or down a little bit, as the case may be, okay? It's kind of like a slow-moving, it's kind of stuck into a wall, but you can still move it up in the back. It still will go up, but the sickle in the front is very modular and can really move, and it kind of sways itself a lot around that. I don't know. What do you think about the 30-day or so, thereabouts?
Yeah, I mean, the one thing that I will say is that on 0 DTE, it is always backwardation. 0 DTE IV is always higher than like even 1 DTE. And like those, you always see backwardation in like the 0 to 2 DTE area.
Yeah. And part of the reason for that is it tends to have you have to put an IV value to cheap priced options. And cheaply priced options, meaning dollar wise, the sheer value of them or the price of them, they get lower like that. They can maintain. It takes a big high volatility to get to a smaller increase in price because time is so short, right?
Yes.
So you tend to see a lot of that in the 0 DTE game. But we would tend to think that this longer part of the curve, and I didn't draw this very well, those are about the same, let's call it, that that tends toward what long-term historical implied vol tends to be, right? It tends to that. And again, in volatile times, it will lift itself above that mean, and in really slow times, it could kind of drag itself down below a little bit, right? But think of it as like a little, I don't know what the right word is, like a little fulcrum of sorts at these points. And these things can really move around this little fulcrum. Doesn't mean the fulcrum can't go up a little bit and down a little bit to make the whole curve go up. But this is the part here that's very flexible, the nearer term, that can really whip around, right? So, and we saw that in this current instance, right?
Yes.
Where is SPX implied vol right now? I want to say it's in the high teens, if I'm not mistaken. Is that about right? I don't have it in front of me. Sorry.
Yes, it is. Hold on. It is 21.93 right now.
Okay. That's higher than I thought it was. So, I saw bigger numbers than that when this all started. And then it's kind of, it's come down a little bit. So I kind of like to keep tabs on not so much 0 DT, but I like to look at 1, 2, and 3 and 4 DT, depending on what day of the week it is. Right, on a Monday I can have 4 days, right, up to Friday, and then on a Tuesday I can have 3 days, and so on and so forth. So I don't like looking over the weekends. I want to see that week in play and see where that is. So that's kind of my barometer for the near term, kind of where that sickle is moving. And right now at 21, 22, that's pretty high. Look, if bad things start happening, for whatever reason, Iran pulls itself out of here and starts bombing Europe, guess what's going to happen? We're going to get some big freaking moves in the spiders and the smooth, right? So there's always. Go ahead.
Yeah, go ahead.
No, you go ahead. You go.
Well, I think the one thing that I'm keeping an eye on myself is I don't, the whole closure of the Strait of Hormuz is it's going to make energy extremely tight over in Southeast Asia and, East Asia.
Yep.
I think China gets a lot of their oil through the Strait of Hormuz.
I want to say 85% comes from the Venezuelan sect, let's call it, and the Iranian sect, as it were. So they get about 85% of that. And, more or less, we're going to control that now.
Yeah. So there's that. And, I think in South Korea, which is not really a part of BRICS, South Korea is looking at, I think they only have like 9 days of natural gas in storage.
Mm-hmm.
And all their natural gas comes from Qatar and, those kind of Middle East countries. So I think these are the things I'm looking at to cause some major whipsaw. Yeah.
Now, do you trade the energy markets at all in any way, shape, or form? Meaning,
no.
Can it be no? Okay.
I will say no, but not because not because I'm like against it or anything. Just right now, Volin's edge is in equities, and we're doing just fine already. So it's like, why shake the apple cart? But I do pay attention to it because it does have an impact on equities.
Right. Okay. Fair. Yeah, I don't think I trade specifically any one sector. I just like to trade prices, I suppose. I don't know if that's the right answer, but okay, here's what I'm doing. How do you trade these markets, right? When you get this kind of volatility. And let's pretend you're a premium seller to start, okay? And you're a premium seller in SPX. I don't care if you're 1 DT to 0, whatever. What happens here with these prices? I'm drawing another little thing on my Remarkable here. Give me a second. So what we tend to see, okay, is and I'm drawing the band of at the money around here. I don't even know where the SPX is off the top of my head because I forgot to look this one.
It's near 68.50, I think.
Oh, well, look at that. I got right. 68.50. Okay. So the puts are on the right, calls are on the left. K is always a symbol for strike in our parlance here, right?
Yeah.
This is OTM calls, OTM puts, etc. Okay. So one thing to consider here, when implied volatility moves higher like it has, okay, and we see a lot of retail folks using the short iron condor as their effective strategy. Okay, I'm not going to debate that. I'm not going to say it's bad. It's good. It is what it is. If you're good at it, God bless. Do it a lot. Okay, so that's all good. But one thing that happens in these implied volatility spike environments is all of a sudden, let's say you're a 20 delta kind of seller of your shorts in the iron condor, right? And for the new folks out there, an iron condor is simply a short put spread. Okay, so you're long one put that's cheaper than or lower in strike than the other put. Oops, that's a short. And then you're short a call spread. Okay, so you're short a lower strike call and long a higher strike call. So the combination of a short call spread, short put spread is called a short iron condor. Okay, and the cool little graph of this baby looks something like this, an expiration graph, and you make money in between where you sold that put and where you sold that call, right? You can realize the full value of that, assume you let it expire. Yeah?
Yep.
So what tends to happen here, or not tends to, what actually happens here is that when implied volatility expands, your 20 delta becomes a different strike now. So what you may be used to as and again, I'm making this up, you may be used to the 6,800 or the 67.75 is your 20 delta. Well, guess what happens? That all of a sudden becomes a much lower strike because implied volatility is higher, right? And when that happens, everything tends toward a 50 delta. So those way out of the money start going higher in delta, right? As do the way out of the money calls. So now all of a sudden you've got an iron condor that spreads itself way out. Okay, now, great, Lex, wonderful. It should be spread out because prices are moving a lot more, right? So that definitely makes sense. Now, you as a user, a trader, have to decide, and this might be your territory, realized versus implied. Is it priced too high or not? Do you have any comments on that? Because my theory is always that, well, the implied volatility is telling me a story. It's high for a reason, and it's low for a reason. So maybe counterintuitively, I should be selling cheaper implied volatility in these environments because nothing moves, right? I'm collecting this crap as opposed to higher implied volatility. I get farther out prices, maybe better prices, but I'm tap dancing on my grave a lot.
So I'll talk about my pre-Voland because honestly, Voland has dramatically changed my strategies with regards to this. But
well, gosh darn, this is a good plug. Let me hit the bell.
Okay, go ahead. Yeah, I will talk before Voland. I get simultaneously excited and scared, kind of like having your first kid.
Yep.
Because you're getting this wide thing, and you're like, oh my goodness, if nothing happens, this is like, money in the bank. I could go to sleep and be making, X percent.
Yep.
And a lot of times it's not wide enough, right? Like when you get into that scenario, it's not wide enough because volatility is whipsawing.
So that just says
scared all the time.
Let me interrupt. If that's the case, that says that realized is actually greater than implied potentially in that environment. Implied is not high enough. It's under VIX, if that's the right word. It might not be the right word, but to me, realized is under VIX relative to what implied is.
Realized is higher than implied.
Yep.
And usually when implied starts shooting up, that's when dealers realize is going to be higher than implied. And it's that, I guess, you could tell me it's that like one moment where the dealers are actually losing money, that very little time frame of the options that are existing right now in your position are actually underpriced when you sold them, right?
Yep.
So that's probably the scary part, but then the price compensates, and then the volatility comes down, and then the dealers make way more than they lost in that time frame, right?
Yep.
But Voland, ever since I've had Voland, we've been able to reprice the skew curve to know if dealers are too low or too high, no matter what the situation is. And we reprice the skew curve based completely on dealer positioning. Mm-hmm. So that's, ever since then, that's when I use am I going short Vega or long Vega in my trades? Mm-hmm. Right now, honestly, I've been long Vega for the past few weeks. We've been seeing dealer positioning being a lot more volatile, even though skew is very high right now.
Yeah, I would imagine it is high. So are you seeing dealer positioning? And all that means for the folks who don't understand this totally is that dealers we refer to as the market makers. Those are the people or the entities that are making bids and offers that you can trade on. Okay, so they're liquidity providers for you retail folks. That's what we refer to as the dealers, market makers, very synonymous. Okay, so it sounds to me that especially downside puts that dealers are getting shorter. Those, is that accurate or not?
Well, I mean, recently we've been seeing them get shorter. Yes.
Yeah. Okay. Which makes sense because there's panic in the air, right? And panic in the air means people are trying to protect themselves. They have to buy puts. The people are panicking. Who sells them? These market maker folks, right? And they develop inventory. So the inventory becomes a Greek profile. And if you're short a lot of options, what happens? You get short gamma. Short gamma works opposite of long gamma, meaning that when the stock goes down, you get longer. When the stock goes up, you get shorter. So dealers have to manage that movement when they have that short gamma, right?
Right.
Mm-hmm. Okay. And that sounds like that's a tell, which is a poker term, to a person like yourself who knows how to use Voland and your users, right? Because you can infer that maybe the dealers have some things they have to do that could cause movement in the short gamma regions. Is that sort of accurate as well?
Yes, exactly. And before the first missile, though, dealers ended up being a lot long gamma on puts. There were a lot of people selling because he was very high.
Yep.
And that's when we saw, Vega, the dealer Vega positioning was a little bit offside. So I was long Vega, right when I ran, right when the first bomb dropped.
Yep.
That was a great position to have.
Yep.
But it actually got hurt a little bit when we backwardized because I had calendars on.
Yeah, but let me ask you a question before I forget. So you said the dealers were mainly long gamma, or I think you said gamma, maybe you said Vega, in downside puts before the bombs started dropping. Is that accurate?
Yeah. Mm-hmm.
Okay, because other folks were selling them stuff and they were inventorying longs, right?
Yeah. Yes.
So of course, when they got their move, over that weekend when we started dropping bombs and the spoos were down on whatever 130, I can't remember. They got their move. So I guarantee you, okay, they're selling stuff, the dealers, in which case now they're probably shorted. So they got to a level where they get out of all that long at a great profit. And don't forget, from a dealer perspective, I'm the dealer. When I'm long gamma and the stock is cratering, going lower, I'm getting shorter deltas. My hedge is to buy a delta. I can buy a delta many ways. I can buy stock. I can buy futures. I can sell puts, right? I can buy calls. Now, it doesn't make sense to buy calls in high volatility. You probably want to be selling something so you get out of your gamma and you get out of your Vega. So what do? They sell puts. And they might sell that inventory that they're long puts. They'll sell that inventory because it's putting money in the bank for them. And they're massaging their inventory out. And it keeps going. All of a sudden, they go from long puts to short puts, which causes them to have short gamma and a little short Vega, depending on where it is, in the process. So they go from a long that they bought lower to a short that they sold higher, and they've made the difference.
Yep.
That's why they're the dealers, guys, right? That's why they do what they do.
Yep.
Right? They're big warehouses of inventory.
That's exactly what we saw. Everything that you just said. I mean, they were long and long gamma puts. And suddenly, especially in the shorter tenors, they went short gamma puts. And that's what happened when they backwardized, because it was mostly in these shorter tenors that people were buying puts, not months down the road. It was like, right now, I need this hedge.
Sure.
And so that's what we saw.
Okay. What this is not investment advice, everyone, so don't think it is. But in your opinion, right? And I'm going to give mine as well. What sort of things can a retail person be looking at in terms of just a general structure? Should they be selling 0 DTE iron condors with higher implied volatility right now? Should they be doing time spreads, buying post-dated options and selling near term because it's so high and we're in backwardation? What should they be doing?
We said not investment advice, right?
It's not investment advice. No, it's just
okay. So let me tell you what I did, and I'm doing probably one of the Lex specials, which is I put on double calendars on either side. And, for the past couple months, we've been bouncing in the same range. So I've been kind of just making money. But the short strike of my calendar is March 17th, which is a Tuesday, kind of strange, like a strange day.
Okay.
That is also the day before FOMC. And my long strike is after FOMC. So I priced it that way because I knew that that short strike would decay faster than the long one because of FOMC and all the, my long one was March 31st.
Yeah.
So that's why, I knew that front one would decay, and I'll probably close it before FOMC even happens.
Yeah. Okay. So that you like that? Is that a double calendar?
Double calendar. Yeah. I did. So basically, especially when backwardized and you have, something, if you have Voland and you could see like where the strikes are that you want to, that you think the market's going to stay above, doing a calendar and a backwardized term structure can be very profitable. Very profitable.
Yeah. And it is counterintuitive because implied volatility across the board is higher. So you're actually buying Vega in that equation when you're doing that double calendar. You're getting long Vega. Now it's priced oddly because the front month is so high and the back month is elevated but not nearly as high, right? Yeah. So you're getting an adjusted implied volatility that is very different from the average of the two.
Yes.
One of these sessions we're going to talk about the mathematics behind that because it's actually It's actually an easy formula. It's probably a little harder to understand, but it's an easy formula. As a matter of fact, we are adding that formula to Tradier Pro. For those of you folks who use Tradier Pro, it will be down in your ticket. So if you do a mixed month spread in Tradier Pro coming up, it's not here yet. We were going to compute for you what that implied adjusted volatility is in one of those diagonals and or calendars or doubles for that matter. It's a nice figure out because what you can do is you can say, okay, I'm selling 100. I'm making these numbers up. I'm buying a 50. It's not 75. The average of the two. It's your new volatility adjusted is like a 51.76. And I'm making those numbers up, by the way. So if your mean volatility IV historical is around a 50, and you can make that spread in a higher implied volatility, you're going to do that spread. That's why I do those in the calendars, because I compute that value. And now I have a movement number that's good for me, but I'm really not going to get too tagged on the implied volatility realignment, right? It's not going to be too much. Right. Even if I don't get my move, I'm going to lose a little bit because the move didn't happen, but it's going to be very mild, very mild. Whereas if I do get the move, which is already priced in, I kill it on the one side, and I take the whole thing off on one side, save the other one for a double banger. Okay, but we'll draw that out on another show. Okay, we got to go. I just realized we're late. Anything else? What else?
Late getting here.
Yeah, no, I was late getting here. Sorry, and I have a lip thing that looks like herpes simplex 12. Okay, go, Jason. Give me the pluggaroo. I got several plugs today for everyone that I want them to think about. So go ahead.
All right. So I got vol.land for accurate dealer positioning. Yep. Ad Dam Funds, which is an RIA using options to control your risk, and I guess Kyrios is our hedge fund.
Okay, in-house hedge fund. That's all fun. Mm-hmm. Okay, Jason mentioned it this morning. We are having the summit in Palm Beach, West Palm Beach, Florida. It's going to be at PGA National on May 7th and 8th. So we'll have the cocktail party at 6:00 on May 7th. Full day on the next day, Friday, of all the people you like on the hub, and a lot of our third-party partners. A lot of SIBO people will be there too speaking. We'll have panels, presentations. It's going to be really fantastic. You'll get to meet all of us in person. It'll be fun. It'll be a really nice event. I've been to PGA a few times. Really great place. That's those dates. Stay tuned. Please subscribe to the hub so you keep track of all this information. hub.tradier.com. It is just an email. There is no fee. Okay, last thing. Email me if you need information. lex@tradier.com. Don't forget to do that. And if you want to book a call with me, you can do that, but you have to email me first to get the details. So I've been chatting with a lot of folks about trading, about the markets, about platforms, about this, that. You can ask me anything. I may not have an answer, but I will make it up. Just kidding. I will get an answer for you. So we'll talk. We mostly talk options with me, but happy to do it. Mm-hmm. What else? Oh, and don't forget to open an account at Tradier, Tradier.com. It's pretty simple. I love it. I trade there every day now. I kind of paused trading for a while. I'm back into it full force, and it's been going great. If you want to know a few things, book a call with me. Otherwise, what else? Happy trading.
Happy trading.
All right. Have a great weekend, everybody. Cheers.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.